Well, hello and welcome to another episode of the Lending Podcast. We are your hosts. That's Jeff
Hello.
Jones, and I'm John Burnham. Thank you for being with us again today. We've got a great topic. We're going to talk about 5 deal killers, transactional deal killers to avoid.
I love it. So you've been around a little bit longer than I have.
A little bit.
20 plus years, like
Yes.
23 now?
23 now. Yes.
23
This
now
summer.
in the industry. So we have a wealth of knowledge going on about what transactions don't make it. It is actually a pretty small percentage.
Very rare.
So
Very
there
rare.
are, one of the reasons why I was blessed to be under your tutelage, use the word tutelage, is because I was told you need a guru when you enter this market. There's a lot of challenges that happen and you got to figure out ways to overcome them. So we're going to talk about, first of all, can you avoid them? Because that's easier than overcoming them.
Right.
And second, if they happen, what to do to overcome them.
Right.
Otherwise, they might be a deal killer. So we got 5 of them that we're talking about today.
Yeah, we want to identify that's part of the discovery process in the beginning of a brand new relationship. We have a client referral, or even a past client comes back to us for a mortgage, but there's been some time passed since we've worked with them, and their situation may have changed. And so, regardless of where you are in that process, the very first discovery phone call, right, is really designed to understand your goals and really understand what potential challenges for your unique situation might cause some challenges or might make the process smoother. And so there's different ways to structure every loan. We've talked about that probably every episode. And so this particular episode, what we want to do is talk about 5 specific ways that you as a home buyer, you as a real estate professional out there, have better knowledge of what can actually cause issues in the loan process, what can cause a loan to not close.
I like it. And we're going to go over 5. It might be good for us just to name them off right up front, talk about, and then we can go and deep dive into each one. So the first one's going to be communication delays. And then the second one is going to be cash deposits. Third one's going to be job changes. Fourth one's going to be major purchases. And the fifth one is new debt. We actually have a laundry list that goes to about 50 of these.
Yeah, there's a lot more than
But
5.
We're hitting the top 5 that are the most common. So before we get into that, I just want to let people know that when you come to a loan officer, we call ourselves a loan specialist, that initial call that you were talking about is really kind of a setup of a file, right? We begin your story. We start getting your documents. We start doing your pre-approval review. That really is, once we look at documents, we get a snapshot of an exact date and time. So everything's dated, right? So we're doing a credit pull that's on a specific date, the date you applied. We're getting your bank statements that are dated. We're getting income calculations based off what you make right now, unless it's going to be an offer letter, then it'll be in the future.
Right.
But for the most part, almost everything on your pre-approval is a timestamp of when you applied, right? Now, it's really a living file that people have, right? So as you go through a closing, whether it takes 30 days or 45 days, or you take a month or 2 to find your dream home, your scenario changes, right? Your life changes. You spend money, you might have a life change happening, something happened with your credit, something happened with your job.
You can't stop life.
So what a loan officer does, and our underwriting team, they have to verify along the way. So that's why, even though you might be pre-approved, there might be something down the road that by the time you close, we are re-verifying everything.
That's right.
And those things have to match within the guidelines of approval. And so it's really kind of what happens between us two, because we catch things up front and just won't pre-approve you until you get those things covered.
Right.
That's fine. Like, that's just a part of the pre-approval process. We roadmap that for you so we can get you to pre-approval. So really, this is kind of a timing concern, is what generally we're talking about.
It's very much a timing concern. And the other way to look at it too is when we issue a pre-approval, we've gone through the application, we've verified documentation, we've issued the pre-approval. It's really our job. It's your lender's job to coach you on what you should be doing between now and closing. Right. So that's what we're going to talk about, because if we fail to coach you, you as a buyer, you as a real estate professional may not go through this process every single day like we do, then you get the pre-approval. You may falsely think, "Oh, I'm good. I'm done. I can go buy that car that I need to
Right.
buy, or buy that furniture, or get that appliance, that new refrigerator because the department store is having a sale, what have you." And so these are all things that we're going to touch on and take a deeper dive. But that's really what we're talking about is
Right.
us as your financial coach from the time that you have the initial call and get the pre-approval. That's a certain milestone we're checking off. Then now you're pre-approved, going to buy that house. You're looking at homes, getting under contract. There's a lot that happens. Like you said, life happens between pre-approval and closing. Let's dive into it and talk about some of those things we can avoid.
Yeah.
Okay,
No, that's
cool.
good.
So number one,
Go for it.
communication.
Communication.
So
What'd you say?
I think one of our episodes we talked about some clients that close in about 2 weeks, about 15 days, and they give us keys to a quick closing.
Mm-hmm.
And one of the things we talked about was certainly a really good upfront phone call, having a complete picture of your goals and what you're trying to accomplish. The other piece of that, and what uh, got those clients to the closing table so quickly, they were so responsive. I mean,
Responsiveness.
anytime we needed something, we were on the phone, we were emailing back and forth, and they were really doing their part as a buyer to get us what we need. Now, we also understand we ask for some things sometimes that spur questions. We welcome those questions. We want you to call us and say, "Why are you asking for this again?" Or, "I thought I already sent you my W 2. Actually, you sent us the tax return that had the W 2 information, but we didn't actually have the W 2." So there's maybe some gaps between what our clients
Right.
think we need and what we're actually asking for, right?
Right.
And so communication delays is a big issue in our industry. And I'll give you a quick example. I had some clients that got under contract, then they already had a trip planned to go out of the country. We understand, again, you cannot stop life from happening,
Right.
while you're buying a house. But that gap in communication of being overseas and not really being able to communicate quickly really caused, a half a day here, a day there, 2 days here, and all of a sudden we've burned 3 or 4 days of a transaction. And that's a lot of time when we
Right.
only really have about 15 to 20 business days typically to close a transaction. So every day is really important.
Yeah. And we have some great podcasts before this one. This is our 26th episode. But if you look back on some of those, we talk about those keys to a smooth and quick closing. And I agree, like the responsiveness, it can't be overstated. Like, um, because if we need something from you, it's because there's a guideline that is saying we need to verify this document in this way, and this document has to cure those needs, right? So if we don't get a full response, then that never gets checked off and your loan sits in processing, right?
Yeah, there are progress stoppers,
Right.
right? Like we need this to then do that. And
Right.
so as we're checking these boxes, I think a lot of times, just from feedback I've had from some clients throughout the years, there are a lot of things that we ask for that are similar. And to a
Oh,
client,
for sure.
they can feel like, "Oh, I feel like I already did that. I already responded to
Yeah.
that email. Or do I need to check that? I already got another request for a documentation. I thought I already sent that in." So I think the clear communication from us, what we're expecting of our clients, is really important. We also want to know, like, how do you best communicate?
Hmm.
Are you really good on text? Are you really good on the phone? Are you really good via email? Because I know for a lot of us, we may have 2 or 3 email accounts, right?
Right.
We have a work email, we have a personal email, we
Yeah.
might have an email we use for all the other
Yeah.
stuff we buy online, and we just want to get all the junk stuff there.
Yeah.
And so, what email address are you using? That actually can cause a communication delay because you just might not check something that might be time sensitive. Now, anytime we need something that's time sensitive, we're also going to call behind that email. But just know that the quicker you get those notifications and responses, the quicker it can move.
Yeah, 100%. Yeah, and it is tricky. Sometimes it just takes a call to go, why are you asking me for, like, why do you need my end of year pay stubs when I already gave you my W-2? Which
Right.
is in most people's minds the same thing,
Right.
right? My W-2 shows you what I made last year.
Right.
But sometimes we need to count more than just your base salary
That's right.
or your base pay. If we need to count your overtime, if we need to count your bonuses, we have to do a average calculation year over year for that, a 2-year calculation. And so we actually need that last pay stub in December that gives us the year-to-date total for that pay,
That's right.
because
Broken
it's not
out.
broken out on your
It's
W-2.
no.
So like there are just these nuances of documents
Mm-hmm.
that are, it might feel nitpicky, but there's a reason to it. And so yeah, communication delays.
And the year end pay stub, as helpful as it is, also saves the client about $85.
Yeah.
Because if we don't have the year end pay stub, a lot of times we're ordering what's called a verification of employment
Right.
from your employer. They charge for that, and then we're charging for that. It's a pass through cost.
Yeah.
I can actually save you almost $100 just getting me your December 31st pay stub,
Right.
right? So those are some little things that if we're not communicating effectively, then the client's going to have, you're going to have questions on why we need the certain things, because it can seem out of the ordinary. Well, the other person I talked, or last time I went through this, I didn't have to
Mm-hmm.
provide this documentation. So we hear that a lot, and it's like, well, your situation has changed, or maybe you started a business since the last time
Yeah.
we talked, et cetera. So there's just all those little nuances. So communication delays, meaning we're going to communicate quickly. We would love quick responses from our clients. That will help us move through the process smoother.
Yeah. No, and that's wonderful. And being proactive with communication, right?
Yes.
So if a borrower is, they had an inspection, they're not sure if they want to move forward with this house, there might be some additional negotiations. Just let your lender know,
That's
like
right.
you're waiting to buy the appraisal. And that's what's delaying that, because you're still negotiating.
That's
And
right.
as long as we know that, that's great. And then we adjust our timeline. We move as fast as our borrowers are able to move.
Yes.
Um,
And I always say, if our clients are in a hurry, we're in a hurry.
right.
If you're not in a hurry, then we're not in a hurry. And that's usually before you get under contract,
Right.
the pre-approval stage, right? Once you're under contract, you've got earnest money on the line, you've got option money that you've already spent, you've got an appraisal, you've got an inspection that you've bought, you may have an appraisal that you've
Right.
bought. You have invested in this transaction. Our responsibility is to make sure we hit that closing date and hit it smoothly with a really nice experience, right? You've got a lot of stresses in your life. The actual mortgage process should not be one of them.
Right. Yep.
So,
And when you go under contract, on that note, like there are hard dates written into the contract of when
yes,
things need to happen. So
yes,
just making sure that we have time to do what we need to do to hit those dates.
that's right.
Good. So that's
Cool.
number one, communication delays. We're going to overcome those. We're
That's
going to
right.
avoid those. We're going to over communicate. We're going to be responsive. Okay. Second one, cash deposits.
Ooh,
Let's
this is a
talk
fun
about
one.
that one. So yeah, so we're smiling because we can think through all these stories of borrowers that all of a sudden we have to do letters of explanation
Yes,
of why all of a sudden you're getting cash infusion into your account and different Venmo accounts
yes,
or just different cash deposits. And on our end, we have these guidelines of what it means to be licensed. And the NMLS licenses us, but we have overseer watchdogs in our industry, and we have layers upon layers upon layers of watchdogs. And one of the things is called a straw buyer, right?
yes.
So the straw buyer is somebody that's buying a home through somebody else. And
Mhm.
so we have checks and balances that are about that topic. And so if somebody is giving a cash infusion to you and you're buying a home, we want to make sure that it's not an investor. And that's where the heart of that comes into play.
Yep.
It's just ownership, like following the money trail.
Yeah, we want to make sure it's not an investment. We want to make sure it's not a loan, right?
Alone,
And
right.
and I think I would also call the avoiding cash deposits, I would say avoiding non-payroll deposits. And so non-payroll deposits, you touched on Venmo, Cash App, all these different ways that we can receive deposits now. And let's also remember the industry, like our society is different today than it was a decade
Oh,
ago.
yeah.
We
Right.
have money, the velocity of money these days is very quick. I can send you money in 5 seconds on an
Yeah.
app, right? And so a lot of
Yeah.
us may be paying rent via Venmo, or you're paying your friends back, or you're getting money from someone owed you money. And so these non-payroll deposits, not your W-2 job, essentially cash deposits, right? The unverifiable deposits, that's really what we're talking about. And so our specific guidelines want to make sure you have not taken on debt, or a partner, or business partner or something, to buy this home. You're not taking on debt to buy a house, which is
Right.
also debt. And so that's really the underlying theme, I think, of what we're trying to verify, is that all the money that we have in your bank account that you have, we can verify.
Yep. And to overcome that is simple verifications of like,
That's right.
you know, what was this $400 you got? Oh, you won a football, pool league,
Right. Fantasy football.
fantasy
Exactly.
football league, and that was your payout. So it's just basically letters of explanation for
That's right.
most of them. If it's an occurring transaction, because we're getting 2 months of bank statements, it's a look back of 2 months. And if we're seeing like recurring, like on the 15th of every month or on the first of every month, you're getting this. So it's a reoccurring pattern. That takes a further letter of explanation,
It
right?
could. Yep.
So one-offs are pretty easy, but when it's recurring, that takes a little bit of a challenge. But we can overcome it.
Yeah, we can overcome it. And I think, especially if it's an outflow, if it's leaving your bank account consistently
Hmm.
and it doesn't match a debt that's on your credit report, then we may dig a little deeper.
Right.
Also, it may work on the inflow if you're getting money on a consistent basis, and the amount does matter. So we're not going to beat you up over $25,
Right.
$50 from Cash App or Venmo when someone paid you back for pizza last night. We're really talking about any cash or non-payroll deposits that are over about half of what you make on a monthly basis. So if you make $5,000 a month salary, if you've got deposits over $2,500 that we can't verify, we're going to dig a little deeper, right? And then what happens a lot of times is it could be a transfer from another bank,
Right.
and then that we need the origin of that transfer. So now we're getting other bank statements that perhaps you
Third-party
didn't,
bank statements, right?
yeah, you didn't
Mm-hmm.
submit initially, and now we have two different sets of bank statements in the file, which could breed more
Yeah.
questions. So that those are some of the things that, again, in the pre-approval process, we're gathering all that information and getting as much documentation from you as we can, so we
Mm-hmm.
don't have these issues. Now, you touched on something right out of the gate, which was during the process of purchasing a home, life is happening,
Right.
right? We can't stop so just because we have the pre-approval issued doesn't mean we won't need more bank statements. And
Mm-hmm.
it means we could need more bank statements. So you want to also be mindful of what you're depositing and taking out of the bank after the pre-approval, right?
Right.
Not just before.
Right.
And that's really kind of what we're talking about, because that could kill the
Mm-hmm.
deal during contract if we have some really large deposits that we can't verify.
Yeah, and on the flip side of it, if we need more cash deposits because you need more cash to close, and it's mid-cycle of a bank statement, and the money came into your account last week, we're going to need some statement from the bank showing that money came in transaction reports or whatever, like a mid-cycle report. So that's good.
Yeah, and a lot of times during the transaction, the deposits that are non-payroll we find are actually gift funds. It
Right.
might be mom or dad wants to help, or
Yeah.
brother or sister wants to help with the transaction. So they've written you a check, you've deposited in your bank, it's $5,000. We don't know where this $5,000 came from. Oh, that was a gift, and then we can go down the requirements for verifying the gift. And there's nothing wrong with getting a gift. There's nothing wrong with having a lot of these non-payroll
Right.
deposits, because the velocity of money is happening out there and there's a lot of transactions. Just be mindful, we're going to need to verify a lot of them.
And I love it. And I think, people are like, well, it's none of your business. Well, we have to verify that you have no new debt that we're not calculating, or we can add that as a new line of debt if we need to. That's not a big deal, but we have to account for it.
That's right.
So that your calculation is correct. And the other one is making sure there's no investor or straw buyer that's trying to be partial owner of this property as well.
And let me add to that too, that a lot of these aren't necessarily deal killers. They may be, but what they are is like super uncomfortable for our buyers to have to go through. Very, very, very taxing. Very, stressful, because now you're gathering more documentation, explaining more
Yeah.
stuff, and it's like, well, that you didn't. How come I'm just now finding out about this? Well, you're just now finding out about it because we just got the bank statement that shows you had a $5,000 random deposit, and now we need more documentation on that. So us educating you of really what we're going to see on those banks, like what are we going to see on those bank statements that could cause us to have some questions. And the other thing is, we don't need all of your assets a lot of times. Like if you've got a savings account and it's got a good chunk of money in there, and there's very little movement, it's
Right.
just pretty static. And then you've got this checking account over here that's just money in, money out, kind of going bonkers every day. And there's a lot of different deposits that you might have to explain. Let's just use the bank statement that gets us the assets that we need, right? So that's where we're going to coach you in the beginning so that you can have a low stress and very kind of pain free experience.
Right. Yeah. And as long as we're good on, following the guidelines, the path of least resistance is 100% always desired.
Absolutely.
So that's good. So that's communication delays, that's cash deposits. Let's talk about job changes.
Job changes. This is a hot topic. This is a hot topic because I think one of our most common questions that we get, other than what are the interest rates today, which we're not going to go into today, but one of our most common questions is, hey, if I get a new job, will that affect my ability to qualify for a loan?
Right.
Or I'm going to change jobs, or I got laid off and I'm getting a new job. Like, how does that impact qualifying? And so I think it comes back to the pre-approval and that communication that we have with you. What are your goals and what's happening in your life in the next 2 to 3 or 4 months that we may need to be aware of? Are you being courted by another company and you might change jobs? Hey, we're this is a confidential conversation. Like, we just need to be in the loop on where your
Right.
head's at and what you're thinking. Because if you're like, hey, I may be changing jobs soon, then let's go ahead and talk about how to structure the loan with the new job. How can the new job impact you? Can we move that job change up? Does that actually help us because it's an increased salary, or does it hurt us because you're changing industries? And we would tell you, hey, you shouldn't make any changes until after you purchase your home, right? Because there are some things that could cause the loan to be denied. And so,
Yep.
if we're diving into specifically a job change, let's talk about a very recent example. So, I have a client who's a teacher, and she's been a teacher at the same school for 17 years. She's now moving to a different city, still a teacher, and she's going to be getting a small raise, which is nice. And she's in the process right now, like under contract, buying the home. We need to verify that new job employment, and we're going to qualify off of the new job employment,
Right.
which is great. We're not, I mean, yes, we're going to do a prior verification of employment. We get to know what she's done prior to this new job, but we're not qualifying her on the old income. We're qualifying her on the new income.
Right.
So this is actually a situation where changing jobs can be a blessing because you can qualify for more house potentially. However, if we don't know about it, it would have been a disaster because we're doing our entire pre approval and our verifications on her current employer. And had we not known she was changing to a different employer, we would have been up a stream
Oh, yeah.
in a really bad spot a
Yeah.
week from closing.
Totally different scenario.
And so really understanding, what's going on is key. So that's one example. I know you've had some experience too with this, and
Yeah, I
you can
think,
shed some light on that.
especially for our clients in this market, people have, it seems like, less urgency to find the right home. So we are seeing a lot of our pre-approval borrowers take their time. I got a call, this was a while back, and borrowers pre-approved, a couple looking for a home, and I called them and I was like, hey, how's it going this week? How's the house hunt? Oh, my husband got laid off. Are we still pre-approved? And that's a tricky question because I was like, I'm very sorry to hear that. I have some further questions to figure out what we can do for you.
Mhm.
Right. So it's not a no, it's what is going on. Like, let's unpack the story a little more. And basically, it we live in Austin. The tech companies go through rounds of, how do you say it, churn of their employment.
They do.
So
Mhm.
there's layoffs and then there's hiring
I
periods.
think they call them RIFs,
Rifts.
reduction in
There's
force.
so many creative
Yeah.
ways to say it.
Right.
And you know, so if I would have just answered her on the phone, well, of course you're not pre-approved if you don't have any income coming in.
Right.
But because I asked more questions, I found out that, next week he's expecting an offer letter on a new employment.
That's awesome.
And I'm like, wow, let's look at that next week. Right.
Mhm.
But between now and then, let's put a hold on any offers on a house until you get that offer letter in, and then we'll do a recalculation. And so
Yeah.
the offer letter of future employment is valid,
Yes.
but it has a certain criteria that offer letter has to meet: signatures, dates, compensation, letterhead, All that good
Yes.
stuff has to be on the offer letter.
Start date.
Start date.
Are we closing before the start date of the new job, and what type of loan is it? Because there's some
Right.
requirements based on that. So it is unique to everyone's
It's unique.
situation.
So job changes happen. We navigate that, but it's not a deal killer.
Right.
We just want to avoid it if at all possible. Don't start a new job search when you're under contract
That's
or
right.
you're looking for a home. Don't proactively quit your job while you're under contract if you don't have anything else lined up.
Yeah.
So we just, basic stuff that we just want to.
That's right. And let's touch on what would be a deal killer
Oh
with a
yeah.
job change. So give you a for instance, if you are under contract through underwriting, oh, now we're clear to close. Congratulations. And let's just say it's Friday and we're closing next Friday, and you quit your job on Monday before closing, that's an issue, right? Like that's definitely going to be an issue. So,
Right.
so specifically, like leaving your job before you close, that will absolutely kill your deal, unless you're starting a brand new job the next day, and we can verify all that. But then you're closing based on the new job qualifications. Could be more, could be less. So I remember, funny story. This is probably, gosh, this is over a decade ago. Okay. And I had a client, his name was Matt. I remember specifically. So Matt was closing, let's say it's a Wednesday morning. He's closing at 11 o'clock in the morning. And he calls my processor. Okay. Her name was Debbie at the time. He calls Debbie and he says, Debbie, I've got some good news and I've got some bad news.
Oh boy.
And he says, bad news is I lost my job last night. The good news is I talked to my financial advisor and he said, go ahead, I can go ahead and close and buy
Oh,
the
the
house.
financial advisor said, sure, you're
The
good.
financial advisor said, yes, you can go ahead and close. Well, let me just tell you, the deal did not close because he didn't have a job. So it doesn't matter what the financial advisor says. It doesn't matter if you have $500,000 in the bank, which he did. He had a huge trust fund and is from his parents. And so his financial advisor was basically saying, did he believe it was a good financial decision to purchase the home? Well, of course, buying real estate is a good financial decision. We must, though, meet the guidelines of our investors, and that is
Yeah.
qualifying based on the ability to repay that debt, meaning you've got to have income.
Got to have income.
And so that was real before a lot of
Yeah.
the added compliance and changes in our industry that we have today. But that was just one of those, funny stories. So, of course, my processor calls me, guess what conversation I just had? And, oh my gosh. And of course I felt terrible. And the buyer was out a lot of money because he lost his earnest money. The contract fell apart. So that is one of those cases, like on or right before the closing, if the job loss happens, that absolutely can kill a deal. We've just navigated you through though how to avoid that, because we can close on that new offer letter. We can close anyway if you've got a new job coming. We just need to know about it.
And one last thing on job changes, just to have some details of specific types of income. So if you go from a W-2 to a 1099 employer, that can be a deal killer.
Yes.
When you're in the middle of a transaction, because a 1099, we need 2 years of history.
That's right.
And so we can't just make up 2 years of history. You can't make up 2 years of history if it's not there. So going from a W-2 to a 1099 may be a deal killer.
It could, for sure.
Yeah, that one's hard to fix.
Yeah, that's really hard to fix. And then the opposite way could be a smiley face. You go from a 1099
Right.
to a W-2, and then
Right.
you'd be fine, right?
I got one of those right now, and it's going great.
Exactly.
You know?
So that's
So,
interesting. Well, cool. Well, that's good on job changes. So let's talk about purchases. Talk about major
purchases.
So
JB, I'm moving in, in 3 weeks. My wife and I are freaking out because we want to move in day one. So we need washer dryers. We need a refrigerator. You're telling me I can't put those on a new Home Depot credit card beforehand?
You can.
Because they're running a 0%. It shouldn't affect my credit score.
Right.
And that is one of the most common, right? Because we get it.
Most common. And think about your Memorial Day sales, your July 4th sales,
you don't
your
want to miss
Labor Day.
those.
There's all, and the department stores are always having a sale. 10% off at Kohl's if you open a new credit card. Please, please, please be mindful. And this is really important. Will it kill the deal? Not always.
Unless it's
Will it
major
make
debt.
your life miserable? Yes.
Yes.
It will make the buyer's life really, really tough. So here's what has to happen. Let's go through the for instance. Okay.
Yeah.
So it's Friday. We're closing next Friday.
Okay.
This weekend, we're having July 4th sales.
Yeah.
Okay. and appliances are 20% off or whatever. You need a washer dryer, you need a fridge, what have you. Could you buy those items prior to the purchase of your home? Yes, you can. Can you even put them on a credit card, an existing credit card? Probably no problem. Should be fine.
Ooh, existing.
Can you open a new credit card with Home Depot or Lowe's and finance those appliances prior to your closing? Please don't do that.
Please.
That's the snake in the grass. It's the new inquiry, it's the new credit line, and it's the new debt amount. So here's what
So
happens. Yeah.
yeah, so it's going to affect your credit score. It's going to
It,
affect your debt to income ratio,
yes. And
and
we have to
we
verify
have to verify
the
everything.
debt. And so it's a
Yep.
brand new credit card. You may have no payments for 12 months.
Right.
That's fantastic. We still have to qualify you on some payment. And we're going to verify that debt with Lowe's or Home Depot or whoever. And we have to do a credit supplement, which adds that line item to your credit report. All of
Increasing
this has
cost.
to happen in just a couple of days, right? Because we're closing next week. So it's
Right.
so in that instance, what you want to do is number one, wait till after closing. Get closed, get funded, go the next day on Saturday, open the new credit card. Hey, what you do after closing is none of our business and none of the investor's business. That's on the record. We just, we're not going to monitor your financial situation post closing.
Right.
I will tell you, just be mindful of taking on debt, especially if you feel like, the house purchase is already a little bit of a stretch. So just be responsible in that regard. But can you take on a new debt after closing? Sure, because we're not going to monitor that.
Buy your car.
Buy that car. But before closing, we do something called a credit recheck. Sorry, not a rescore, but a credit recheck right before closing. What we're looking for is new inquiries and new debt,
Right.
debt that we didn't have counted for when we got you approved.
Mm-hmm.
So those are the things that can really derail a transaction. And a lot of times we don't even know that the client's going out shopping because they've sort of made that decision. Or maybe we told one of the spouses there's two people on the loan. The other spouse found this great deal. They went ahead and bought it, but the other person knew not to take out new debt, and there wasn't healthy communication there. So that's the biggest issue. Can you go out and pay cash? Probably, most likely. Let's have a conversation, make sure it doesn't impact your loan, because there are certain loans that require cash reserves.
Right.
And if you use up some of your cash reserves, that could actually disqualify you from the loan.
That's important.
Possibly.
That's very important.
And then, of course, putting it on an existing credit card would probably be fine. We're not checking to see if your balance went from $1,000 to $2,000 necessarily. But again,
So
just
that
be
is one of the
mindful.
best ways to make that available. But if it's a very large amount, please check with your loan officer
Absolutely.
ahead of time.
Yeah.
Um,
I'd say any large purchases, we say just check with us before you make a large purchase. I think anything over $1,000 is a large purchase. For
Yeah.
some people, anything over $300 may be a large purchase.
Right.
But whatever you feel is a large purchase, for us, I would say $1,000.
Right.
During the process.
Mhm.
Now, if we know you have a healthy bank account, and $1,000 doesn't really make a dent, then that's fantastic. But if you're really watching those dollars closely, and we are sliding into home, so to speak, on this purchase with just enough money, then we want to be mindful and keep as much of that cash in the bank.
And I feel like that, that's number 4 is major purchases. And I feel like number 5 is kind of hand in hand with it,
Yeah.
with new debts. So what are some kind of examples of new debts outside of what we've talked about?
Well, first, let's take a car, right? Let's just take
Car's
a car
a big
example.
one.
So I remember specifically, I had two gentlemen that were buying a home together. This was probably 5 or 6 years ago, and the real estate agent, and this is where, as a real estate partner, you've also got to have your antennas up. Like, you're another pair of eyeballs for us to some degree,
Right.
on this process, and we're eyeballs for you, right? So
Right.
my real estate partner calls me, real estate agent, and says, I was just at the house with our two clients, and we're doing our walkthrough. We're closing, it's Tuesday, we're closing Thursday or something.
New dealer plates on their car.
And she calls me, she says, did you know that so-and-so has a brand new Ford F-150 truck?
Yeah.
And I said, no, I didn't know that. And we started unpacking this. And long story short, we were able to still close the loan. However, it was tight, it was close, and it was very painful for the borrower
Yeah.
for the reasons we just talked about, because we had to get that information from Ford, we had to get the payment verified, we had to add it to the credit, rerun the underwriting, the automated underwriting, to
Hmm.
make sure that the debt to income ratios, the approval was still solid, which it was, and that's good, and it was all smiley faces at the end. But it was a chaotic and stressful 72
Yeah.
hours, unnecessarily,
Right.
when that truck could have been purchased a week later. And we're not saying close on a house and then go take on debt. What we're
Yeah.
saying is, if you're going to do that, life has to happen, right? Then do as little as possible to disrupt the mortgage process,
Right.
because of how many checks and balances we have.
And sometimes we can, so that, we of course would like to avoid that, but there are times when you can't avoid getting another car, and you just need transportation. So that's when we, as loan specialists, can try to help forecast that for you. So especially with people relocating,
Yes.
that's when a lot of these come up, right? So it happened to me when I came here.
Yeah.
So we moved from Buffalo, New York to Austin, and we were renting in the area to figure out where to buy. So we sold our home, so we had a bunch of cash, right? But one of our cars was getting aged, and we didn't want to drive two cars across country.
Right.
So we sold that one there, came here with one car. Well, we need two cars for how we operate our lives. We got kids, we got
Two
two
jobs.
two
Yeah.
jobs. Like, you need two cars. And so we knew we were going to buy a car here. Well, we're also needing to buy a house here. So we're buying a house and a car. So as a loan specialist, when we do pre-approvals, we can put in, you know, we can put in line items that could be forecasting, right? But we have a caveat, a little asterisk on that pre-approval. This pre-approval scenario is based on verification of the new car payment, and so provide us your first statement
Sure.
once it comes in, because sometimes there's delays on that, and that
Mm-hmm.
can hang up your closing, because we need to verify actuals. We can't just verify estimated.
That's right.
And so there are ways to forecast it, so at least the debt to income ratios are within guidelines.
Yep.
But then we just need to verify docs.
Well, I think
So,
what you touched on is the most important piece, is we have to verify a payment. And when a
mhm,
debt is so new, that payment's not reported yet.
right.
So it's the gap between buying something and it hitting your credit that we have to bridge, that gap with documentation.
Yeah,
And of course, when you buy a car, you have all the paperwork from the dealership, and you have all your payment
it's a
information.
lot of paperwork.
It's a lot of paperwork. That's perhaps an easier debt to verify than, say, your Home Depot credit card, because
Right,
especially with that 0% no interest for 12 months or
right.
whatever, we don't there's not a statement from
No, it's
the
just a printed
department
receipt
store.
with no terms.
Yeah.
Right.
And so verifying that's the tricky part, and that's
Hmm.
really what causes the delays. And then our clients, response may be something like, well, it's only $30 a month, like this isn't a big deal. And I
Yeah,
agree with you, it's only $30 a month, it's not a big deal. However, it must be
yeah,
verified to meet the guidelines of the investors. They're loaning you $500,000 or
right.
$300,000 or whatever. So
And we get it.
yeah.
It's emotional, especially when you have, large sum of money in your bank account, sometimes more than you've ever had in your bank account if you just sold your house or if you've been saving, and challenges arise and you want to start spending that money because you want to have the better life now, right?
Yeah.
Just make sure the timing, again, we're coming full circle on timing, the
Mhm.
timing works in your favor, not against you.
Yeah. Yeah.
So,
No, that's well said. I know we touched on five. Like you said, there's probably 50. There's
right.
several other things, but I
Yeah.
think these are the most common ones. Job changing right now, it seems to be the hottest topic, I think. With how would that impact my
Right.
approval? I got pre-approved with job A, but gosh, I've got a couple offers out here. I'm looking at other, perhaps even other industries. And we
Hmm.
didn't really dive into that, but to circle back to job changes, another important reason to have that conversation. If you're staying in the same industry, it's typically smiley face, no problem. If you're changing industries completely, that's where it could really impact your qualification as well, and how you're paid. So just a lot of little nuances.
And that has to just do with there's higher risk of continuance. Excuse me. So it's just really the reason why changing industries is kind of
Mm-hmm.
a challenge for a lender is the ability to repay. If
That's
you're
right.
in one industry for multiple years in a row, and all of a sudden you're changing industries, we don't know if you're going to be successful,
Mm-hmm.
right? And so that risk factor goes up. We don't make that judgment call. That's just how the guidelines go.
Right. Yeah, and variable
Right.
pay uh, can weigh
Oof.
in because a lot of folks, I'm sure
Yeah.
those folks that are listening to this, when you change jobs, it's usually for a pay increase, or maybe it's for a stress decrease, but most
Right.
times it's for a pay increase,
Right.
right? And so that pay increase a lot of times is variable. Hey, it's a nice base salary. However, look at this upside. Well, the upside's future income that we're not able to use for qualification a lot of times.
Right.
So just really having a clear picture of what you're trying to accomplish, and then also what's going to be happening in your life over the next few months as we're on this journey together. That's real important. So
Good.
we're here for you guys. I appreciate it. Yeah, that was a good topic today.
Yeah, well, thank you so much for listening today. And we appreciate any kind of comments that you could leave below. And we will take those to heart. We'd love to have some podcasts and responses to comments. But thank you so much. Feel free to like, subscribe, share the Lending Podcast. Thank you.
Take care. We'll see you next time.
Bye.